Economics Managing Loan Funds, Maximizing Benefits, and Minimizing Returns webinar for the Community Action Partnership. Thanks for joining us, and we really appreciate you coming on this Friday afternoon. I don't know how the weather is over there where you are, but we're here in Washington, D.C., and it's quite nice outside, if I must say so myself. So we have Glenn Pineda on the line, and I'm going to officially introduce him in a bit, but I do want to go through some housekeeping issues and concerns. I just want to let you all know that your lines are muted, so you don't have to worry about any kind of background noise because I've taken care of that on my end, but I do want to let you know that we're recording the webinar so that, you know, just in case you'll know that this is being recorded. Questions can be asked through the Q&A tab, or you can send me a private chat. My name is Linda Hembry. I'm the Program Specialist for CED, as you see there on the screen, under Stacy Flowers, the Director of Community Economic Development. So you should also be able to receive the recording at the end as well as the webinar slides. So I have to say that will probably be more closer to Monday or Tuesday before I can actually get them out to you. So I will, without any further ado, go ahead and introduce our presenter, who is Glenn Pineda. And some of you may recognize this title of the webinar from our conference that was held in August. We did a workshop similar to this. And, it was full information, very well attended, and so we are going to go through some of the similar information that he covered there. But Glenn is very familiar to the partnership in that he, many years, has been with us in terms of speaking at our conferences and also helping 400 community agencies across the nation. He's the Director of Technical Assistance for California Economic Development Association, commonly known as CEDA. He has over 13 years of banking experience. He was the Senior Vice President and Regional Manager for the Bank of America. I assume that's over somewhere on the West Coast in California, there where he is. And for the last few years, he's focused on community-based lending and investments. He has a BS in urban planning, and he graduated from the Development Training Institute in Baltimore, Maryland, and the Pacific Coast Banking School at the University of Washington, which is my hometown, so rah-rah for University of Washington. So, all right, without any further ado, we will go ahead and get started. So I'm going to go ahead and turn it over to you, Glenn, and I hate to put this on recording, but I forgot to tell you this before we started, that I upload your presentation with the two parts that you send it to me. So at the top, you'll see the managing loans, and then you see the loan funds part 2. So when you're ready to go to that part, you can just take your cursor and put it over that little loan funds, and that will allow you to be able to, you know, do the second part of the presentation. Okay, so sorry for all that technical stuff, but we're going to go ahead and get started. All right, take it away.
Thank you. Let's see, a quick bit on my background. You know, before I joined BA in their community development lending group, I was with a nonprofit for 13 years, involved with housing and economic development activities. So I've always kind of worked with nonprofits throughout my career. Even at the bank, we were trying to figure out ways to get capital to community development organizations. So my role here now at CEDA is very similar, where we work closely with groups and trying to help them with their community development projects, helping them get financing, and whatever is needed to make their programs and projects work. The way kind of set up this presentation, basically I'm going to go over a little bit of the information and data that you could pick up from the Community Partnerships website, and it has a lot of the background information and data that really help you explore different subject areas of CED a lot more. And then we're going to go into an extensive case study. It's actually Grove, South Dakota, a community action agency that covers a little bit half the state of South Dakota, providing lending, and they've got an extensive program there. Marcia Erickson couldn't make the session today, so I'm kind of filling in for her and covering what she would be presenting. This is very similar to our session we did in New York, so if you attended that, this will be very similar sounding to you. Let me get rolling here.
And before you get rolling, I did want to let you know that we do have Lori from Grove, South Dakota on the line. So.
Okay, great.
Yeah.
She can pop in and talk about things that I'm missing here. But yeah, let me get started.
And Lori, you can just raise your hand if you want to say something while talking about your agency. You can just raise your hand and I'll unmute you. You know, she said, okay, but she can't say anything, so, okay.
So the Community Action Partnership, we've been working with them, we meaning CECETA has been working with them over the last 3 years in developing a lot of training materials around CED. Part of that work includes a lot of materials that are part of their website now under the Community Economic Development area of their programs. Now, the website is listed there, and if you're looking for CED resources, that is the web address for that. And I'll tell you exactly what you'll find there. A lot of it includes toolkits, webinars, case studies, and this is the access to directly to the toolkits, and I'll kind of explain what those are and how they're kind of organized. Now, the toolkits that have been completed to date, this is the list of them, and include a lot of different community economic development subjects. There are a lot of real estate ones that we have put together for groups getting involved with affordable housing development, single-family development, as well as commercial and retail activities. And then there's quite a bit that we've put together more recently focused around loan funds and different types of loan funds and different types of business development activities. The rough toolkits, the ones that the ones that are listed there, include one on community development financial institutions, alternative financial services, financial education, small business technical assistance. All of the toolkits are designed to provide information on generally what this subject is, kind of historical look at it. They talk about how to run a program in that subject area, and it really focuses in on resources available, things that you should be thinking about if you're getting involved in it. Coming soon, these have been completed and they're getting approved from the feds. And here, signs, we're right near a police and fire station, so we get this all the time. And it gives you the feel for what's going on in downtown Los Angeles. Coming soon, so we hope those will be online shortly, and they really kind of pertain to a lot of the information we're going to be talking about today. So what we have put together in terms of toolkits, the first one around community development loan funds, this is kind of the broad category that includes all types of loan funds. We separate out credit unions and equity investment funds because they're very much a different type of animal. But underneath community development loan funds, you'll find groups that are doing microloan funds. And so it's a subcategory that really focuses in on smaller loans, a lot of startup, a lot of assistance for entrepreneurs who are kind of starting their own businesses. And it's important to kind of segment it because microloan funds have its own unique issues and kind of management issues as well as fiscal issues that you have to deal with since they do deal with smaller loans and generally speaking a tougher population in terms of credit worthiness. creditworthiness. In credit unions, it's a federal state designation for lending institutions, and it's very much like a bank in terms of it having certain capital requirements, as well as having all their systems in place before you get your designation. And under credit unions, there's a subcategory for community development credit unions, one that are really focused on low-income communities and kind of the work that we all do from a nonprofit perspective. The equity investment funds, it's a very interesting animal in the sense that very much like a loan fund where you have funds available, but you can invest them directly into a business. And an equity loan fund differs in the sense that it's essentially equity into the project. So you can actually design it so that, for example, you retain partial ownership in the business, so that if you put a couple $100,000, you might own 5% of the business. If it's successful, your return comes as part ownership of the business, or 5% ownership. Or you could structure it as a loan, and typically it would have to be a loan that might be above what a regular lender might do in terms of loan to value. It might have loan to values that are above 75 or 80%, and thus it looks like equity. The nice thing about having it structured like a loan is that you get paid back and then you can revolve it. And a lot of groups really focus on that, and I know GO has been involved with a lot of CED grants from the department, but the CED grants, Community Economic Development Grants, out of OCS. So OCS has kind of two sides. They fund a lot of CSBG programs, but also under their CED programs, they provide grants for economic development projects up to $800,000, and it's kind of an annual grant process. And organizations can actually, for example, you were working with a business or a company that you wanted to locate in your community, you can actually get a grant to bring them into your community, provide an equity injection, whether it's partial ownership or whether it's structured as a loan, to that entity. The whole goal behind it is to create jobs. I think the standard is one job per $20,000, but we've seen the average being about one job for about $17,000 in winning applications. But the nice thing about it is some organizations, and one good example is Howard Snyder's group, the Northwest Side Community Development Corporation in Milwaukee. They use this tool a lot with other funds that they get in terms of using it as an equity investment. And their whole goal is to bring in companies that create jobs into their neighborhood. And so they provide equity and enticing communities to, enticing corporations to locate in their communities. In all cases, they might be expansions. They might be startups or a branch of some sort. So, for example, it might be a company that manufactures something that's agreed because of the dollars coming in that they'll be able to buy more equipment to hire more folks. So they've been doing this since about 2000 and invested over $6 million into various companies, and they've created over 500 jobs into their communities. So it turns out to be a really great kind of a product. And they've structured them in most cases as a loan. So what they end up doing is revolving it. So they constantly bring in more CED grants. They invest them, they get returns on that, and they go ahead and do it again over and over. So they're able to bring in and grow their fund to quite a bit of an extent. Any of the interest that they gain or fees that they pick up from their fund they're able to use that for their operations. It's actually income to them, and they can use it for anything they want. The principle coming back is it needs to go to something very similar. So it works real well in terms of revolving into similar type businesses to create jobs. Five is the federal designation. So basically, if you're a loan fund, if you're a credit union, a microloan fund, you can become CDFI. It's a designation that you apply for through Department of Treasury. The thing is that once you get that designation, you can apply for a CDFI, different types of funding that they have. One being a technical assistance grant, where if you're starting a fund, it gives you money to do all the research, the market study, putting all your regs, putting in your guidelines and management structure together to become an effective loan fund. So the technical assistance award is very important, but also they have financial assistance awards, which you get a grant that has to be matched, but essentially a grant to get your fund started. So it works out real well. Let's see here. I'm going to focus a bit on what we have done, what we have seen over the years, and what bankers really focus on when they look at loan funds out there. And basically what we're really looking for are successful business opportunities, what banks are looking for investing into different organizations. The first kind of hurdle these days is that DFI designation, and it's really important to have that designation. It's become kind of like the minimum bar that most financial institutions, as well as foundations, will look at, that you at least be a CDFI. It means that you hit certain hurdles and you have some capital and experience. So that's probably the first thing that is important to do. My process isn't really almost at all. Your primary mission, promoting community development, be a financing entity, primarily serve one or more target communities, provide development services in conjunction with the financing activities, be accountable to your market, and non-governmental entity. So, in most cases, most nonprofits and community action agencies all fit that category. The second kind of level, and what I'm seeing more in the industry, is having your CARS assessment rating. And CARS is an assessment system for rating CDFIs, and it's been put together by the Opportunity Finance Network. So if you're thinking of becoming a loan fund, or you are a loan fund, it's really important to look at the Opportunity Finance Network. They're a national organization. They focus on serving CDFIs and loan funds. They provide a lot of different services. They've got an annual conference that I think is coming up soon, as well as a lot of materials available to help you with your loan fund. So the CARS system is an assessment and rating system, and they look at impact performance and financial strength and performance, two different areas. It's a very comprehensive kind of third-party analysis that a lot of investors and grant makers are looking at as being a standard for them to invest into your loan fund. So impact performance under the CARS rating system, they're just looking primarily at effective use of financial resources to achieve missions, so that that you're kind of effective business operations, and you're trying to meet those lending goals that you've laid out. Finance strength performance, and they use the CAMEL rating system. They look at capital assets, management, earnings, and liquidity. And what they do is under impact performance, they have the lead ratings, AAA, AA, A, or B, and then financial performance, they rate on a scale of 1 to 5. So once you've been rated, so you all end up being a AAA number 1, you're in good shape, and a lot of investors, as well as grant makers, will look at you. And these are some of the institutions that rely on CARS, and I'm noting that there are more and more of them out there. So it's important to be able to, one, with CDFI, secondly, get your rating once you're in operations. As you can see, most of the major banks and financial institutions are the CARS system, and they will make grants as well as investments as well as loans into funds based on that rating system. I'm going to talk a little bit about what you can get from banks and other financial institutions. And this really kind of is all very similar to foundations, the way they're structured. Your point of contact with these institutions are through a CRA, a Community Reinvestment Act loan officer, or a community development representative, someone who's kind of a marketing management type person. And what they will do is they're like the doorway, the person that you usually see at meetings, and they will work with you, hopefully, to get you to the right place. And there are different places in the bank, and sometimes you end up in the wrong place, and it really doesn't make sense for you. So in some instances, you might end up on the lending side of the equation. You might end up in the investment group. You might have a specialized community development investment unit, or might end up at the foundation. Each one is very, very different in terms of what they provide. In some instances, they don't even know who's doing what on the other end. For example, if you're talking to a commercial lender at a financial institution, they might have no clue what they're doing in terms of community development investments or what the foundation's looking for. So you really need to kind of ask to make sure you want to get the right person. So if you end up with a lender, on the lending side, you're probably a pretty strong group, and look at you as a business. They'll look at you to see if you fit their lending guidelines, and they'll provide a loan to your fund, typically at market rates. Typically, they're very risk adverse. They don't look at anything except to make sure that you're able to repay the loan. And so it works well if you're doing co-lending, which means that your loan is going into a project and providing maybe 50% of it, and you're co-lending with another bank. That loan will probably come out of the regular lending group. So they'll make their loan at their standard rates. They'll do their standard underwriting and be very, very conservative, where they expect your matching fund to be kind of the flex dollars into the deal. So they're really looking at kind of market rate returns under a market structure. This investments. Investments differ from lending in the sense that investments will usually go to higher loan to values or do things that are kind of outside the lending box. Whether it's looking at projects by a nonprofit, or it's something that's different from the regular lending guidelines. It'll go through their investment side, and then their rates are going to be very market oriented. They're very risk adverse, very similar to the lending side, except they're looking at things that are slightly out of the box. Lucky enough, and you have a community development in that institution, or they've got a community development program, their investments are a really good source, because they're typically looking at low market interest rates for their investment. They're really kind of guided by what CRA is telling them, the Community Reinvestment Act, that they're doing it because they know they're not successful or active in certain markets, or they're not hitting certain market goals. They also know how to use tax benefits. So if there are state programs and other programs that provide tax benefits, they melt that into their investment side, and they're able to give you a better interest rate. They have a higher risk tolerance, so it's a lot better to be in this part of the equation than it is if you're stuck on the regular lending side or investment side. The foundation is the best to be out of the whole world. Foundations do provide investments under EQ2's equity equivalence, which is, or PRIs, where they do investments into projects. But generally speaking, they'll provide grants. And they're very good for startup loan funds. So if you're starting a loan fund, you want to be talking to the foundation folks. You want to be able to talk about dollars for operations, or dollars and capital for your loan fund. Remember, you're looking for two different types of dollars. Either you're looking for operational dollars for the management side of the equation, or if you're providing technical assistance, it comes from that source, from the operations side, or you're looking for dollars for your loan fund. Dollars are great for your loan fund because it really lowers your overall net interest rate of your loan fund, so that if you have dollars invested from one company that's giving it to you at 5%, you have a matching amount of dollars at 0%, you're able to make a lot smaller interest rate loans than if you had all loans only at a higher interest rate. So grants are very important. Make sure you ask, if you're talking to your CRA officer, that you get directed to the foundation because you want a grant and you don't want a loan, or you don't want an investment. Some development tips that we've come across: managing expenses. It's very, very important to manage your income and expenses for your long-term survival. Like I mentioned earlier, it's real business, so it's really important that the business operations make sense. And it's a business in the sense that you derive income from your loan pool. You're making loans out in the marketplace. You're getting a return at a certain interest rate that it's hopefully above your over loan pool interest rate. And that spread is what covers your operational activities. So that if on a long run, if you're have a large fund and you're creating a lot of income, it pays for your operations. Essentially, you're running a successful business. Partnerships are important, and it's a way to cut down on marketing expenses. It might be a way of cutting down on loan processing and loan management. So if, for example, you have a loan fund and you cover a county area, you might want to make sure you're partnering with other business organizations that provides technical assistance or provides contact with different communities that are out there, so that they know that you're available and you've got loan funds out there. Cuts down on your marketing expenses in the sense that they're the ones who are going to be referring business activity to you. Business activity meaning loans to you. Loans just decrease the size of your loan pool and lower your potential income. Getting money, if you're making bad loans on a consistent basis, you're not generating any income essentially, and so it starts eroding the size of your loan pool and the potential income you could generate. So loan losses aren't good. It's good to be aggressive in certain markets, or it's good to be meeting community needs, but there's a balance between that and credit worthiness and making sure that you can get repaid. Impact your business success. Reserves essentially funds that are set aside, don't generate income. So, for example, if you and let me kind of back up. So you've got a loan fund, and let's say $200,000 of this fund is a loan from a bank, and you have to make payments on that. So you have dollars out there. So any income you're generating goes to repayment of that loan. Losses reserve is dollars set aside so that any loans you make out of that $200,000, if it goes bad, you have to have those dollars available to repay the bank or the financial institution. So the larger your loan loss reserve, it's just money sitting on the side that's not being out in the marketplace generating income. So it becomes very important that that your loan losses aren't big because they just sit there. It's just your reserves sit there and are set aside for losses in the future. Your guidelines and approvals impact your success. This is what I kind of spoke about a little bit earlier. The greater risks you take, the greater for potential losses. And it's not to say that you don't take risks at all in doing these kind of projects, but what it's called it is that you're able to manage risk. So that if you're looking at doing certain types of financing in communities, it's that you understand what that risk is and how it's mitigated, and you're able to provide a loan that makes sense, that will get repaid. And in most instances, it's that flexibility and ability to understand your market that most banks don't have. They don't have the time to understand every single community out there, or they don't have the time to understand what different communities are, or cultural differences there might be in business activities. Expenses for marketing, processing, management, managing small loans are the same as a larger loan. And this kind of gets back to the whole kind about micro loans versus small business financing. Where micro loans, you have a number of small loans out there. Under a regular small business loan, let's say you make a loan for $100,000 to somebody. In a microloan environment, you might make 10 loans at $10,000 each, or 20 loans at $1,000 each. But the difference is that the time and energy spent in managing, actually closing and managing one loan is the same as doing it for the smaller loans, relatively the same. So all of a sudden, your costs for operating and management are greatly increased because you are has to get out the billing. Someone has to manage that loan. Someone has to make sure repayment is occurring for a number of loans versus just one. So your costs go up. Sharing loan management, portfolio management functions. It's an excellent way of managing and reduce expenses. So we're saying here is that you have that capacity to manage loans and are doing well at it, or if one of your neighbors are doing a real good job of it, you might want to subcontract that work to them, or they subcontract that work to you if you're really successful at it. If you're good at it and you can get other folks' loan funds to manage, you can generate income by just providing that service for other folks. Or vice versa, if you have a smaller fund, you want someone else to manage it, you pay a little bit for having that management services done, and you get the work done, but not have to carry a full staff to get the work done and the reports put together. Okay, and this is very similar. Marketing, that experience and ability to generate income, to cut down on your costs. Finally, CDFI certified and get course rated. That's probably the two biggest steps in your process of becoming a smaller fund into becoming a larger fund. And remember, it's a business, so you're looking for capital to grow. Your business must be sound. So, the system, the underwriting banks or other financial institutions will do, they're looking at your capacity. They're all looking at your management systems. They're all looking at all the little pieces that make you successful, that keeps your loan fund operating. If they're investing in you, if they're providing loans to you, they want to be repaid, so they want to make sure that you have the capacity to do that. Way for you folks out there who might be thinking of starting a fund, some basic things you need. You really need to have your market study done. Why is there an overwhelming need for you to put this fund together in your community? What community or business or residential need is there that you're going to be addressing? You have your business plan. Your prospectus is essentially your ask. You want to make sure your board is all part of this process and really understand what's going on, as well as finding key individuals on your board that can help you with this. One suggestion that we have in terms of process, if you are looking at this as a new loan fund, is to work with your local banker, those you understands what you're trying to do. Have him part of this whole process. Have him part of the development team that's putting your fund together. Create a tentative loan committee made of local lenders. So your local friendly banker is the guy who's bringing in other lenders to say, hey, this group really knows what they're doing. There's a real need out there. We need to address it. With these folks, put together some sort of a concept paper on what exactly you want to do. If you have four here, you're in pretty good shape. If you can get a local congressperson or someone, a representative, along with maybe some of the financial regulators, and every bank or financial institution has different types of different regulators who are monitoring them, whether it's the OCC, the Office of Comptroller of Currency, or it's the FDIC. There's somebody who monitors that bank to make sure that they're doing their right work in terms of community development lending. So if a congressperson or your regulators are calling a meeting to bring in all the institutions that serve your community, sit down at a meeting and hear what our community needs is, sure as hell these guys are going to show up. They'll show up, and they won't just show up with the CRA officer. They'll show up with a senior staff person, a senior manager. And the nice part about that is they're the ones who will make decisions. So at that session, you're able to present what your needs are. And in most institutions these days, they are looking for effective CDFIs out there. Over the last 4 years, business financing, especially for small businesses and anything else that's tougher to do, banks have just been totally out of that business. Anything that doesn't fit the most vanilla type lending out there wasn't being done, and that's why CDFIs are so important. So banks and other institutions are really relying on effective CDFIs to hit those markets that they can't do internally, and they really rely on you as an entity that understands your community and are able to make effective lending successful. So they're looking for ways to meet community needs. So in a lot of different ways, this process here that we're suggesting is something that really helps them. That means that someone else has done their homework to understand what the needs are and understand how to address it, and you're the one who's going to be able to do that for them. I'm going to kind of go through some slides I'm going to go through it a little bit faster and kind of stop on some of the key points that kind of exemplify some of the things that we were talking about. The abolition in 1966 is a community action program. There's really three organizations under Grow South Dakota. The Community Action Program. Let me get this thing up here. Their Community Action Program, as well as their Economic Development arm that manages their business revolving loans, and that was done at a later time. And that was done about 1978. And an entity with statewide presence was established in 2007. So they have different funds that have kind of been put together to meet certain needs. Northeast South Dakota Economic Development Corporation serves 22 county service area, visiting lender of last resort, and that's kind of the role that CDFIs take. The housing lending repayment rate, 99.5%. That's above excellent. You're looking at institutional numbers around 5% losses on a lot of loans, similar to that. So being under that, it's really good. Statistical information: 332 loans, 14 million in loans outstanding, and historically, you can see how many business loans they've made, financing over $48.5 million. Housing loans, 88 loans, financing over $1.7 million. And I think they've created one job for every $5,475 of loans that they've put out. So the job creation numbers as a result of loan funds as well as business TAs, it's astronomical. And the small business being the engine of job generation for our economy, it's true. And growing small businesses are a very, very effective way, or is a very, very effective way in creating jobs for your community. Active loans under South Dakota, let's see, 39 historical loans. Business loan programs, direct loans, and CD pledge loans. Direct loans 500 to 250,000. CD pledge, they essentially provide a CD, a certificate of deposit, that they put into a lending institution, and it's collateral as kind of on a shared risk basis to finance a business. So, for example, if they're doing a small business, they'll put a CD on deposit into that bank, and it's kind of covers some of the more obscure parts of losses that a bank might be concerned about going forward. Start a revolving loan fund, develop loan policy, and this is like the kind of important steps in thinking through a loan fund. Understanding what your loan products are, what types of loans you're going to provide, the terms, interest rate, and fees. Depending on the types of loans you want to do, if you're doing businesses, if you're doing equipment loans, you've got a shorter term, maybe 5 to 7 years. Real estate, maybe 15 to 20 years, and then you might want to have repricing on real estate, after every 5 years or something like that the loan will be repriced. So a lot has to do with what your market needs are, what niche you're trying to fill to determine what loan type you have, what terms, what the rates will be. And rates are always dependent on cost of funds. So if your loan pool is made up of a lot of high-interest loans or a lot of high-interest investments, then you're going to be making loans at an even higher interest rate so that you have that spread that generates your income. So you want to make sure when you're putting your loan fund together, you're not just taking any dollars that come by, because they might be at a dollar amount that is way too expensive. quick note is that Grove, South Dakota, and we've been working with them or talking with them and them being involved with a lot of the work we're doing, is that they did win the Partner CED Award as a Master Innovator. And you can tell this by the extent of activities they're doing with their loan funds, but also see some of the other ancillary work they're doing. Let's see, underwriting guidelines, eligibility, loan review, decision making. And so it's really important to understand your writing guidelines. You know, who's eligible, how are you going to value collateral, what are documentation you need. If you're doing real estate financing, you really want to know, be able to get the environmental reviews done. If you're involved with equipment, you know, you're going to be having your UCCs done. You're going to have all processes in place, as well as fees that are going to be charged. The loan packaging side, if someone's submitting a loan, is there a fee going to be charged to that, or is there going to be some sort of a rate that you could put in, depending on what their income is, that you could do more or less in terms of fees. Collateral values is kind of interesting, and you know, eventually you have to determine if you're taking a piece of machinery or equipment as collateral, what the value of that is. So it's you to really know what that process is. And then even loan approval, when you get down to the loan approval and reviews, who makes the decision, who's recommending it, who has the authority to take loans. You know, your loan officer, are they able to make small loan decisions, or do all of them have to go to committee? So it's a type of real roles and responsibility decision making has to be done. Risk management is a very, very important part of loan funds. And let me go through this real quick because this is one of the important parts of it. Your loan pool is made up of a lot of different loans, not your loan pool, but your portfolio. And some of them are doing real well. Some of them might not be doing very well. Some of them are in deep trouble. So every organization, and banks do this too, they'll risk rate their loans. And on that risk rating, they'll still set aside your loan loss reserves based on it. So here, what GROW has used, a 4% loan loss reserve on prime, meaning your best loans. And once you get down to doubtful, 50% loan loss reserve is set aside for doubtful loans, and at losses, you take the 100% of it. So if your portfolio is made up of a lot of troubled loans, you've got a lot of dollars in your loan loss reserve that isn't being used to generate income or support businesses in your community. So it's that fine balance that you've got to really work when you decide what your program is. Lessons learned: never take second position. Have bankers on your board of directors, community representatives on your board, and that's the balance. It's having the bankers understand credit, and it's having community folks on your board to really focus on what community needs are. So it's a balance between the two. These meetings are very interesting when these folks get together to talk about it. Don't be afraid to ask questions. Don't be afraid to deny a loan. Training courses. There's a lot of courses out there and a lot of training available. OFAN is a real good source, as well as other entities out there, as well as a partnership providing a lot of training. Is it worth? Yes. Funds recycle. You generate income. You jobs. So one of the funding sources, and I'm going to kind of breeze through this real quick because we're in the end and we want to take some questions. USDA, the CDFI, I mentioned they have technical assistance as well as financial assistance. Small business, VA has a lot of different programs. HHS, Office of Community Services, I talked about that in terms of bringing equity dollars in. Wells Fargo has a great EQ2 project where they provide very low interest rate loans, maybe 2 to 3%. Nice part, they give you all the money that you can stick in a bank and get it out into your marketplace. I think you make quarterly interest payments. USDA, Treasury, all great sources for capital for your fund. Remember, you're also looking for operational support. Risk sharing. You can do deals where you work with other financial institutions, so that maybe there's another CDFI or small bank who's willing to share in the loan that you're making, or it could be a governmental source that's providing that capital to share in that risk. Housing financing, they do a lot. Go does a lot of partnership loans, working with other financial institutions, and great because you're sharing risk and you're making your capital stretch a lot further to do a lot more. Improvement loans to 10,000. The USDA 502 program. These are direct lending programs from USDA. Home Loan Bank provides a lot of different federal home loan banks. There's a number of them throughout the country that serves regions. They provide different AHP, Affordable Housing Program awards, where you can get grants for affordable housing development activities, whether it's rehab or new construction. Small Business Center. A real important piece is having access to technical assistance for your small businesses, so that if they do get in trouble, or even before they get in trouble, that they have the training and ability to understand a lot of the credit needs, as well as understand how to keep their books. And if they do get in trouble, they have a source to support them. As you get bigger and as you become more experienced, New Markets Tax Credits is a very, very important tool for economic development. And typically you're talking about deals that are over $6 million, and it's primarily commercial type projects, commercial and community facilities. But it's a way to bring in equity dollars that the credit are sold to investors, and it brings in a lump sum of money into a project. And grow with a part of the reward for a master innovator is that they've been involved in developing schools, and there's some major projects that they're involved in bringing and using New Markets Tax Credits. The housing projects and rehab work they're doing, and financial education, again, a very important piece to support your lending activities. Here's an example. It's all going to be available to you, so you could kind of go through and take a look at how they feature some of their activities. Apartment management. Question, because otherwise I could talk for about 10 minutes or 20 minutes on each of these subjects. NeighborWorks is a program where access to capital, essentially, and technical assistance for home buyers. You're able to use their capital to acquire homes and rehab them. Partnerships, 250 and I think that's a real important number. The partnerships they've created over the years, working with different types of funds and other resources, sharing risk as well as being able to generate capital. And here is their final information. And I'm going to turn this back over to Linda for questions. I know I'm cutting this shorter than I need to.
Well, thanks a lot, Glenn. You may be able to back up and try to get some of those additional slides. I didn't see any questions that came in specific to the presentation.
But we'll give you a a quick play-by-play. The 747 that's carrying the space shuttle is flying by downtown right, and I slightly distracted.
Oh, no, you're missing it.
Yeah.
Let's see. If you wanted to, you could, you could cover anything, that else that you want to. We've got about a few minutes. I don't see any questions. So.
Okay. Well, and I think that Grow Dakota is an example of a fund that grew probably from a real small fund and kind of increased because of their ability to have these great partnerships, as well as accessing federal dollars, whether it's OES dollars, whether it's USDA funds or SBA, to be part of their program. And as they start doing that and increasing their market area, as well as NeighborWorks dollars, you become someone that institutions seek out. So if I'm Bank XYZ, who has a footprint across the nation, and I see that we have 20 branches in South Dakota, and our numbers on the CRA side for home lending and small business lending stinks, I'm gonna call Marcia up, and I'm gonna have make sure I have a conversation with them and make sure that they want to take some of my dollars to invest in part of their funds, so that I'm covered, in terms of CRA, in terms of being reviewed by other entities. So it becomes really, really important that as you grow, you kind of grow exponentially just by having more and more people start looking and calling you.
Glenn, I did. I muted Lori Quinistad, who's on, and I hope I'm pronouncing your name right. Lori, I did unmute you, so I saw your notice. So if you could just speak up, that would be great.
Thanks, Glenn, for the overview and for, our agency as an example here. It doesn't happen overnight. We're in existence for over 30 years, so our fund has really grown over the years. Excuse my phone here. But certainly, like he said, if you have any questions, anything, you can certainly, the contact information is there. You can contact us. We can share ideas, share thoughts. That's the thing as far as what we do and how we do it.
And thank you so much, Lori. We really appreciate you staying on the line and sharing. That was great. And so if there aren't any other questions, had Glenn, anything else that you wanted to?
No, I think.
Okay. Okay. Right. We also, and we're waiting with bated breath for our web developers to finish their tell information on the website that they're doing, and then the Grove, South Dakota case study will be on the website. So we are going to be publishing that, so you'll be able to take a look at that as well, and along with I think 9 other case studies from agencies that have won awards over the years, since I think 2010, leading up until now. So we're at about 2 minutes before the end. So I just really wanted to thank all of you for attending, and also provide our information, contact information, which I think was supposed to be on the first slide. But anyway, so we again, in all being here, and we're going to continue to offer these. First, we have another one coming up on the 26th of September, dealing with how to start or continue a successful IDA program, Individual Development Account. So we have Julie Jakopic, who's going to be speaking about that, and we also have our archived webinars that are on our website at partnershipced.org under resources and then webinars. So you can go ahead and take a look at and listen to any of the past webinars as well. And here is Glenn's contact information, as well as ours. There we are. Okay, well, thanks again
And thank you so much, Glenn, for providing the information, which was excellent.
Thank you.
All right. Okay.